Welcome to SB Talks. Today is Friday, June 21st, and I am joined as ever by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Today, Nick and I will be discussing the recent GYG IPO, the continued rally in Australian banks, and European inflation trickling down, and it wouldn't be a podcast without a brief mention of NVIDIA too. I'm going to start with the hype story of the last few days if we can. Nick, Guzman y Gomez IPO. The IPO markets have been fairly, I don't want to say dormant, but certainly quiet for a while. Back with a bit of a bang, GYG listing, up over 30% on its first day, I believe, to a 3 billion market cap. Quite the valuation.
Yeah, I mean, basically it's the largest IPO since November 2021, obviously. Right. The market's been very subdued for new listings, and this is the largest one, so it's excited the attention of a lot of the fund management community. Yeah. And I think the interesting thing with this is it's actually quite a small offer in terms of the size of the company. So the company's now valued at about $3 billion. But the number of shares issued was quite small. So I think they only raised 335 million, 200 million right. New money and 135 sell down. So there's a lot of a squeeze for funds that, like these sort of things to actually get some shares.
So the very benefit difficult. Of the listeners, that's they've only made a relatively small portion of the company available for float and for listing. So for the demand meets supply, there's pretty limited supply, which is probably contributed to that price pinch.
That's right. So that's, I think, one reason why we saw it, trade 36% above its issue price on the first day, just because there's only 15% of the shares sort of freely available to be traded. Now,
I know we're not going to want to get into the territory of specific top stock recommendations on this podcast, but definitely a lot of hype / question marks over the valuation. Let's talk about how they valued it at float and why that's probably caught a bit of attention.
Yeah, so the fund managers sort of have been a little bit, they've either liked the story, and sometimes it comes down to them being, personally familiar with the brand and maybe
the people
eating there.
Yeah.
But some of the fund managers we've spoken to are very, I guess, sort of on the more dubious or skeptical side. I think at the offer price of $22, it was valued at 32 times earnings before interest, in tax, depreciation and amortization. And there's also some question mark about how they treat leases of the stores.
Right.
So maybe that number maybe
how they chosen to account for some of those.
That's leases. Right. Yeah. So maybe that number is understanding. I mean, to put it in context, the net profit after tax forecast for the current financial year is $3 million.
Right.
So this is a company with $3 billion market value with $3 million of profit.
So it's a very tech-like equation you're sort of setting out there for a burrito restaurant.
Well, that's right, and they've articulated a plan to take their current footprint from, I think it's 210 stores, 185 in Australia, a few in Japan, Singapore, and the US, to 1,000 stores over the next 20 years.
Yeah.
With a big US expansion plan, and you have to think. They don't have Mexican restaurants in the US.
Taco Bell, I think, has been around for a little bit.
Yeah, they have. I mean, they have in the US has every flavor of probably Mexican restaurant, and lots of chains and various ones have sort of come and gone. And one of the fund managers we were talking to said, they actually had a very similar one to the Guzman y Gomez format in the US already.
Like a slightly more premium type
format. Yeah. So you do have to think there's a bit of froth in the current share price.
And as you appropriately articulate, the limited amount of free float in the shares is going to cause a little bit of that excitement pinch once the excitement gets going. Now, we can't recommend or otherwise direct stocks, but we can recommend the burritos. So I'll bring my daughter. My daughter's a major fan.
Yeah.
She's a major fan, so we could probably bring her in to do a review on that, but perhaps not on the shares.
I do. There is a joke that I think Billy Connolly said that Mexican food is the same 5 ingredients folded many different ways. So there's the tacos, the burritos, the enchiladas.
It's good. I'll be honest, the food is good. But whether that justifies a $3 billion market cap on $3 million of profits, it's a bit of a stretch. But we wish them the very best.
Absolutely.
The other area on the local exchange that's caught attention in recent times has been the run-up in valuations of the banks, in particular CBA share price, just punching ahead. What's driving that?
No, also NAB, actually. So both CBA and NAB are up about 30% since November. And really not much is driving it. I have spoken to some of the portfolio managers we work with. They call it ABC, anything but China. So a lot of money now has flowed out of China funds, or sort of out of Asia Pac funds from China,
in China,
into Japan, India, and Australia, which is seen as a sort of a safe place to invest.
Proxy play on China,
and most of that money has flowed into the large cap names. So the banks have had a big run. Some other consumer stocks like Wesfarmers has had a strong run, Goodman Group. So it's been a few of those stocks that are just trading at fairly crazy prices. So to put it in context, CBA is one of the most expensive banks in the world on a multiple basis, around 23 times earnings. That compares to JP Morgan at less than 12 times earnings. So it's been treated almost like, a bit of a tech company in some ways. And
their growth outlook isn't quite there to justify that multiple.
No. And particularly if you think about the Australian economy, well, we've probably got interest rates where they are for longer, even the risk of maybe another rate rise. So that's not necessarily great for credit growth. You have, a lot of the buy now, pay later kind of eating into their sort of, consumer lending. You've got the mortgage originators eating into their mortgage book. You've got private credit eating into their business book. So it's a pretty competitive environment.
Regulators continuing to hover in the background, overlooking everything they do as well. So
absolutely, and then you also say, well, I look at the analysts. So of the 15 analysts that cover the stock, 12 have a sell,
right?
2 have a strong sell, and 1 has a hold,
right? Okay.
And no one has a buy.
Yeah.
And the target price is around $93, which is where it was roughly back in November. So 127 seems pretty expensive, and even some of the short sellers now have started to target the stock.
Right, picking up a bit of momentum there.
Yeah.
How does that make you think about the broader value of the ASX, given financials make up such a significant portion of the index?
Yeah, it's something I've been watching for the last few months, and it's starting to look pretty expensive, the Australian market. So you've got the banks that are expensive on those metrics that I just mentioned. You have the miners, which aren't that expensive. They really haven't done much over the past sort of 6 or 12 months, given kind of what's going on in China.
Yeah, a little bit of trepidation about what's happening in China affecting them, weighing on them.
And the non-financials, non-banks, so what we used to call the industrial sector, is expensive. That's around 20 times earnings, because it's such a small part of the market. And, we talk about Guzman and Gomez. There's just too much money chasing kind of too few opportunities, particularly if there's earnings growth.
And people are trying to underweight potentially the financials given that, and there's just not a lot of other places to go.
That's right. Yeah. So it's expensive. You can get companies probably with similar earnings growth outlook. Much cheaper overseas. So
now we have a larger weighting in the typical portfolio to overseas shares than Australian shares, but perhaps one that we continue to keep an eye on in terms of valuations and value. We had an RBA meeting in the last week. Anything catching your attention on that one?
Yeah, it was interesting. I mean, it was like the result of being on hold was largely as expected, but I think what was interesting was the subtle shift in language in the post-meeting statement, and also Governor Bullock's press conference afterwards, where they did suggest they considered a hike. So they certainly didn't consider a cut. They did consider a hike.
And put that on the record.
Yeah. They used the word vigilance.
Right.
That got a lot of attention, that word. That's a new word. And so they reinforced vigilance to upside risks to inflation. Okay. So they want everyone to know they're watching and they will act if needs be. And they also added the term and we will do what's necessary to achieve the outcome, i.e. returning inflation to target within a reasonable period. Right. So that's a new comment. So if you look at all of that, you say, well, they're alive to the risks.
They're putting people on watch that are on notice that this is a real possibility.
Yeah, absolutely. And at the press conference, there was some discussion around things like the amount of money the state government's are spending. So that's effectively stimulus coming into the economy. You've got the tax cuts, you've got the energy rebates, you've got house prices going up. So all of these things at the margin are sort of supportive for the economy and the consumer. So that's sort of, you can see Governor Bullock maybe a bit concerned about the outlook.
She's in a challenging position because there's a lot of pressure on her, let's say politically, about cost of living, and that's real, and trying to give a bit of relief to those that are most affected by it. But the inflation challenge is a significant one, and I guess that's her primary job.
Yeah, absolutely. So I think we'll get the June quarter CPI at the end of July, and the talk is if that comes in at 1% for the quarter, we could see a rate hike.
Right.
The expectation is sort of around 0.8. 0.9 probably wouldn't get them to shift, but anything 1 or above, which is, what's that, 4% annualized, that could get a rate hike. So I think the market's...
How are they pricing it at the minute?
There's about 3 basis points priced in. So what's that, about a 10-15% chance of a rate hike? It seems like maybe a little low, but it's very data dependent, and so August is possibly a live meeting for a hike, if that's a bad number.
We'll watch that one with interest. I'll skip across to Europe if we can. The last podcast we talked about the EU elections there and an unfolding political climate, and a UK election coming up over the next couple of weeks as well. The European Commission has been on deficit watch and pinging out a few, warnings. How would you formally describe them?
Yeah, so the EU treaties, when the European Union came into effect, I think it was the Maastricht Treaty, there were certain rules about deficits and total debt to GDP that countries had to adhere to. And one of those was the 3% of GDP deficit. That was the largest deficit you could have. Now, there are 7 countries in the EU, including Italy and France, that have deficits well in excess of that. And so the European Commission has criticised 7 member states and has signalled that the deficit's too high, and there could be some what they call the excessive deficit procedure. So some penalties, basically, fines and things like that, to try to bring them back in line. Now, obviously, you've got potentially Marine Le Pen's party, and you've got the left-wing alliance, and they're all sort of, populist parties that like to spend money or tax less. And some of them are sort of a bit anti-EU as well. So it creates a scenario where there could be a bit of volatility around what's going on. And we've seen French bonds trade to the highest spread to German bonds since 2012.
Give me some context. How much more expensive is that?
Yeah, not a lot, but it's gone from 50 to around 80 basis points spread over the past couple of months. That's material. So that's pretty big increase, just reflecting, that's for the 10-year, reflecting that sort of sovereign risk in France.
Well, it does add an extra complication, an extra little bit of spice. Not that any was needed to these upcoming French elections. Also, a bit of activity UK-wise. Their inflation numbers, Bank of England, they're looking at that.
Yeah, so their inflation at a headline level's at 2%. So it's come down.
Job done.
Pretty quickly. The core number, not so much. It's 3.5%. And they've still got a bit of an issue with services inflation. That's 5.7% over last year. So it's really been on the goods side, the energy, food, those sorts of things, the more volatile items. But the expectation is that the Bank of England probably would have liked to have cut last night or this, at its most recent meeting, but they kept it on hold, just given, I think, the elections coming up. They didn't want to be necessarily be seen to be favouring.
I think that election looks like a done deal if anyone's following that in any way, shape or form.
I think the expectation is they'll probably cut maybe at the next meeting.
Yeah. But they're certainly building up the potential room to do that.
Yeah.
And not probably uncommon there that the inflation's coming down, but some of that services related, much like other parts of the world, that's slower to work its way through the system.
So we also had the Swiss National Bank did their second cut last night. So another 25 basis points down to 1.25. Their inflation's at 1.5%. Right. And obviously the ECB has also cut. So we're starting to see the early signs of central bank rate cuts, particularly over in Europe.
And moving from Europe across the US, we've talked regularly about reasonable resilience in the US economy, the expectations of a raft, 6 or 7 rate cuts this year, rapidly being pulled back to 1 or 2 at most. How's the economy positioned there? We've seen some signs of softening from their high, 5% plus rates.
Yeah, we're seeing some signs that the economy's starting to slow a little bit at the margin. So things like retail sales were soft, housing starts, building permits, which are obviously rate sensitive. They've been pretty soft lately. We've started to see the initial jobless claims go up. So the last week went up, and the sort of 4-week moving average has gone up a little bit. Not a lot, but just starting to see some of those signs that the US economy is cooling a bit, which obviously is helpful for the Fed at the margin.
Yeah, that certainly buys them, I guess, a little bit more room, but again, too early to tell.
Yeah, and the Fed speakers over the last week or so have sort of said, yes, early signs, but they obviously don't want to give anything away and get anyone too excited just yet.
And it wouldn't be a podcast if we don't talk about NVIDIA. And I did prematurely on the last podcast, I think, say that they briefly got to the number 1 spot. They hadn't. They'd only got to number 2, as you correctly pointed out. However, the NVIDIA march continues, and they've enjoyed a brief stint of pipping Microsoft at the top. It's just quite remarkable.
Yeah, so it's funny. NVIDIA, Apple, and Microsoft sort of all vying for that number 1 spot. And so, yes, NVIDIA was briefly there, I think at 3.3 or 3.4 trillion US dollars, which is even larger than the whole Australian market put together. Yeah. But it gave that back. But yeah, it's probably going to bounce around, and I wouldn't be surprised, just given the strength in that company in terms of its earnings, to see it to go further.
Because it's correct me if I'm wrong, but up about 300% over approximate 12-month time frame. You think they're not that this is in any way, shape, or form a prediction, but the earnings growth has got some more legs yet.
Well, their revenue's gone up 5 times. Yeah. So the share price has gone up 3 times. Yeah. Revenue's gone up 5 times. So that actually the earnings multiple is cheapened. Because some people are saying, well, it's just a one-off. Well, these companies do.
Some of the big tech have been doing a one-off major build-out in their infrastructure as they make an AI investment and trying to work out, well, what will that investment be in 2 and 3 years? Yeah. But it's staggering figures. Yeah. And certainly all the Mag 7, as we talked about, Microsoft in itself, the share price has really rocketed ahead. We've had Apple make their announcements regarding their AI and how they're embedding that into their technology in the last couple of weeks. It's a fascinating, rapidly moving space, and well, we only hope that it also brings productivity gains at some point, because probably Australia could do with that, and that would help the inflation fight as well. But for now, it probably brings a bit of inflation, as we all have to go and pay for all these different AI things, and then hope to get some productivity out of them. An excellent summary as always, Nick. Thank you very much.
Thank you.
And thank you to all our listeners.